Welcome back. I'm Jeremy Szafron. Tensions in the Middle East are rapidly escalating. Over the weekend, the United States launched targeted airstrikes on 3 of Iran's key nuclear sites in what the Pentagon called a, quote, limited preemptive action. Now, President Trump claimed that those sites were obliterated, but the UN monitors say full damage assessments are still underway. Now, Iran vowed to retaliate, and that retaliation is now unfolding as we tape this broadcast. According to Iranian state media, Tehran launched at least 6 missiles towards an airbase in Qatar, the largest American military installation in the region and home to nearly 9,000 personnel. Now, Qatar says it successfully intercepted the missiles, reporting no casualties, and is now reserving the right to respond under international law. Qatar has closed its airspace. The U.S. Embassy in Doha is urging Americans to shelter in place, and the White House has confirmed that the Defense Secretary and the Joint Chiefs Chairman are now in the Situation Room. President Trump expected there shortly. Oil initially surged more than 5%, but has since reversed lower, with Brent now down 4%. Analysts say that the markets view this as a controlled escalation, a face-saving strike that may avoid targeting energy infrastructure. Now, the dollar has firmed up, but gold barely moved, still hovering around $33.80 an ounce after setting a record high of $34.54 earlier this month. Silver also trading about $36, up nearly 27% year to date. Now, some analysts say that gold often predicts global instability more than it reacts to it, and there may be a deeper shift underway. According to a new report from the European Central Bank, gold has now overtaken the euro as the second largest official reserve asset worldwide. Now, the ECB says that gold made up 19% of global FX reserves in 2024, while the euro fell to 16%. The U.S. dollar remains dominant at 58%. And according to the World Gold Council, net central bank purchases are up 14% year to date, led by China, India, Turkey, with many institutions continuing to accumulate despite hitting allocation thresholds. And joining us now is someone with a front row seat to these shifts. Randy Smallwood is the CEO of Wheaton Precious Metals, a $40 billion streaming and royalty powerhouse, forecasting 40% production growth in the next 5 years. Randy, welcome back. Great to see you.
I mean, always a pleasure. What a world we live in though today, eh?
It's crazy. Just before air, I mean, we're changing the story as it happens. And again, we might be a little bit late to the party when this goes to air. But let's begin with this weekend's U.S. airstrikes on those Iranian nuclear facilities. The market reaction was subdued. I mean, I mentioned oil moved slightly, gold held steady. But given the nature of the target, are you surprised we didn't see a larger move in gold? Or does this tell you something deeper about how gold is priced today?
Well, I mean, there's no doubt. I've long referred to gold as a comfort metal, and in times of stress, that's where people go to, is for comfort. And so there has been a strong shift and a strong growth in demand for gold over the last while. We've seen central banks and sovereign wealth funds all build up a larger piece, and as you referenced, now a larger reserve asset than the euro. Not surprised at that, and I do think that eventually it's going to continue growing. And so, I do think gold is a much more, one of the advantages of gold is I think it almost, I'm going to say, smooths out the impacts. It's a pretty big market. And so, with what's been going on in the Middle East, I think, this is an extension of an existing challenge that's been going on there. And so I would have expected a bit more of a move with this, but we are seeing some good strength and again, additional stress, geopolitical stress in the world is, I hate to say it, bodes well for gold as a comfort metal.
Yeah, you said it well. I mean, would you say that the market already priced in geopolitical tail risk earlier in the year, and that gold's, pricing is now more about the sovereign trust and the long-term monetary positioning than the short-term conflict we're seeing?
No, I mean, to be honest, what I would have to say is I think the United States and Israel have long been strongly linked, and what we're looking at right now is just an expansion of what we've been dealing with already with Israel and Iran and other challenges in the Middle East. And so this isn't a whole new thing. This is an expansion of an existing challenge that's been in process for a number of months now, if not years.
Yeah, we're calling it the new monetary order. And of course, we've been talking about it here at Kitco News. It's starting to get some mainstream news organizations to wake up. But I mentioned that the ECB says that gold is now the second largest global reserve asset after the dollar at 19% of the reserves, overtaking that euro, as we mentioned. At the same time, these central bank purchases, I mean, they continue to buy, Randy, even as overall pace somewhat moderates at these prices. What does that signal to you about where the world is headed monetarily? I mean, they're holding more than the 1960s at this moment.
One of the most foundational aspects of any type of reserve currency is that it needs to be abject. It needs to be void of political risk. It needs to be apolitical. And the challenges that we've seen with the US dollar, and for that matter, any other fiat currencies, but the US dollar being the main reference currency that we've got, is that they are subject to political influence. And that's one of the reasons we're seeing such a strong shift towards gold, is gold is not a politically influenced commodity. It is widely accepted. It shines through in that kind of an environment, no pun intended. And so, that desire to have an apolitical, a non-politically influenced store of value, measure of value, is always going to push support gold in the face of the euro, as you suggested there. But I think it's climbing, as we see, against the US dollar also. And so I just see continued growth for that perspective, especially when it comes to central banks and sovereign wealth funds. That core value, that core reserve, they're very, very risk averse, and they don't want that political risk exposure. So we're going to see continued growth that way.
Yeah, and we're also seeing political pressure in Europe, particularly in Germany and Italy, to repatriate national gold from the New York Fed. Are these repatriation calls part of a broader move away from, U.S. custodial dominance, you think?
Well, no doubt. I mean, what we've seen is a real threat to globalization, which is all part of one planet. The trade, the challenges, the tariffs, everything that's come into play here is all going to feed towards I think it's time for us to focus on delivering in our backyard. And we're seeing that, the spillover effect, I think, of a lot of the tariff threats and the trade issues around the world is that countries and communities, cultures are all now sort of looking within to find out how they can stand on their own 2 feet in the event of. And situations like redomiciling gold back to the home nations, that's all a spillover effect of that deglobalization trend that we've seen really started off a couple of years ago, but and it continues to get stronger and stronger, especially with all the tariff talk.
Yeah, the tariff talk. Randy, if custody becomes this geopolitical liability that we're talking about, do you expect physical gold markets to increasingly decouple maybe from futures and ETFs, creating a two-tiered system of pricing?
Well, we have seen that just by geopolitical. We've seen Shanghai premiums substantially different than what we've seen in Europe, the LME based, or even in North America. And so we have seen a bit. There's always going to be a change in demand. Now, I do think that as time goes on, we will see improved ways of owning gold where you don't have to have the physical move. But this whole trend towards deglobalization is going to be it's going to have a big impact and support that. And so you will see that on a localized basis. Increases in demand locally will have to be satisfied one way or the other.
Yeah, back in January, the last time we had you on the show, you said silver had a clear path to 40 this year. We're still, at 36, but we've seen some really strong momentum. Are we still on track? Or are you seeing signals that the rally could stall or stretch out here?
Actually, I like the trend that I've seen in silver right now. We're starting to see the ETFs pick up, and the ETFs have always been a great way of measuring retail demand when it comes to precious metals itself. So we're starting to see the silver ETFs pick up. And that's my argument behind silver is that it needs that retail demand as an affordable precious metal to come into play. The silver markets, the United States, the American precious metals investor has always been an important trigger with respect to the silver space. And again, another clear indication ETF holdings has said that we've seen a pickup in interest in the United States. And so I'm pretty bullish. I think we're on track to, as I don't remember saying that in January, but we should see it before the end of this year.
Yeah, to your point, I just did a quick little thing. It looks like ETF inflows on the silver side up about 2.1 billion this year. Industrial demand just set a quarterly record. I mean, what's driving silver more in your view right now? Monetary hedging? Is it the solar and electronics demand, or is it the shift in the investor positioning that you're talking about?
Well, industrial demand is great if you want materials to move on that, and definitely the growth and to be honest, the shortfall in supply. We just haven't had good production growth in the silver space for quite a while. We hit peak silver production back in 2017, 2018. It's been dropping on a pretty well annual basis ever since then, with a couple of spikes. And so, no doubt, that's one of the reasons I do like silver, is you've got that base industrial demand. But really, what's going to move the price is going to be that focus towards the precious metal, the retail investor looking as a store of value. Silver, that's typically what will take it off. It usually lags gold, and gold has definitely had its move. And so seeing silver start to wake up a little bit over the last couple of weeks, I would say would almost be predicted. We knew it was coming. We just weren't sure of the timing, but we're starting to see that strength come into play now.
And it feels like more and more people are talking about silver just from a retail perspective. I mean, over the weekend, I was talking to people and they're excited to buy silver coins again. I mean, are people seeing it more on the monetary side with these gold prices so high, kind of a easy access to the metals?
I just got back from 4 weeks of marketing various different stages all through Europe. And I don't think I've ever heard so much discussion on silver. And usually what I found interesting about that was that Europeans don't usually ask much about silver. To them, it's a bit more of an industrial commodity. But boy, the appetite level from investors and funds, as I said, our company, close to 40% of our revenue comes from silver, and there's definitely an interest level in the commodity itself. So more interest out of Europe than I've seen in a long time.
So is that going to push us over 40 by this year? What do you think? You kind of like them at these prices right now?
I think I already gave you 40 by the end of this year.
Yeah, we did. What's the biggest risk on silver's move higher, though? Is it the global growth kind of rollover? Is it maybe the lack of strategic reclassification, or is it just profit taking in an overstretched market?
No, I mean, I don't think we're going to see a bump on the supply side. So it's going to be demand driven. I am a little bit nervous about solar panel demand because that has picked up a lot, but at the same time, or has had some challenges. At the same time, to me, what's going to drive silver is that retail demand. It's got a kickstart. We got to start seeing the retail precious metal space look at the affordable precious metal, which we call silver, and start stepping into that as a store of value. And that's what'll give silver the kick.
Let's get into the precious metals company side. We'll talk a little bit about capital strategy and the streaming dominance, because I mean, Wheaton is forecasting record production and cash flow in 2025, especially at these prices, huh, Randy? I mean, you've added streams in West Africa, Ethiopia, Canada, but you're kind of staying out of the M&A rush we're seeing across the sector. Why? What's the strategic calculus behind avoiding these corporate acquisitions and just kind of adding to production?
Yeah, the challenge in the streaming space is that we're so G&A efficient. We don't have a lot of overhead, so there's not a lot of corporate synergy in terms of combining companies and putting them together. It's not like some of the operating companies that have promised hundreds of millions in annual savings in terms of corporate G&A. Our corporate G&A is about $40 million, and we're the largest in the space, $40 to $50 million. And so there's not a lot of synergy benefits. And so if we can continue putting our capital into the ground on promising projects at attractive valuations, why would I pay a premium for some of the peers? Especially, one of the challenges that we have is at Wheaton, we really do pride ourselves on being a streaming focused company. 100% of our revenue comes from streams. Mm-hmm. And our structures, we find, will stand the test of time. We've had a very good track record in terms of preserving that. And so inheriting some other people's problems just hasn't had a lot of appeal to us. It doesn't have the same value to us. And so yeah, it's not as attractive in the streaming space, mainly because of the lack of critical mass in terms of synergies that you gain by putting the two entities together, and the valuations and some of the structures that just kind of get in the way. Not that we don't watch and keep an eye out, and if we see an opportunity for an accretive price, we will step into the space. Mm-hmm. But there's nothing that's jumping out at us right now.
Interesting. I mean, you and I have talked about this before. As the consolidation kind of happens and the juniors are being, positioned out with more expensive capital, has that consolidation happened where we have more legitimate miners or producers out there that aren't just spending on promo kind of thing with the G&A costs?
It's the lack of growth in the entire industry that's driving this, right? when you sit and look across the seniors and the mid tiers in the gold space, it's tough to see any sizable growth in their production profiles. And for the longest time, they've been talking about flat as the new up in terms of trying to just maintain production profiles. There's a lot of very tired mines in this world, and so that's always going to stimulate a demand for the operators to actually step in and acquire some of these smaller juniors as they get up and start moving forward. So our approach at Wheaton is to finance these smaller single asset companies, get them into production. We've got the Artemis team at Blackwater is up and running nicely. We've got a number of other projects, 4 new mines coming into production this year within our portfolio, and another 5 over the next 3-4 years. And so fund these assets. They will eventually be acquired by the mid tiers and the seniors, because they're going to need that production in order to maintain their own production profiles.
Yeah, it's a heck of a model, and I want to get into it a little bit more. Before we do, I mean, your cash position is over $1 billion. You've got zero debt. Streaming deals now outcompete traditional equity for many developers. Are equity markets still mispricing mining risk, and is the performance gap between streamers and operators now permanent?
Nothing's permanent in this world. This is a cyclical industry. You always have to be flexible and maintain that, right? Currently, streaming is the most attractive source of capital, especially for single asset development companies where debt is challenging. There's certain aspects of debt that are attractive, but when it comes to the single asset development companies, it gets pretty expensive. We've seen plenty of examples in this space for junior development companies trying to move themselves forward with debt and paying quite a high price. A stream is got much more flexibility. It's tied to a percentage of the production. And so compensation is directly correlated to your sport. It just gives you so much more capacity when you turn it on. And so we've had some pretty exciting transactions over the last while that, as you mentioned, West Africa, the Montage Gold on the Koné project, an incredible structure that I think delivers real value. There's a company that's going to turn on production without any debt. They're going to have a nice healthy stream for a while, but that's going to replace the need for debt in terms of moving forward. And I think that's a good example of where we can take the streaming model. We definitely have a lot of appetite for those kind of structures.
Now, you got into it a little bit there. Are you seeing fewer viable streaming candidates, or is the bar just higher? I mean, what are you screening metrics today? Is it jurisdiction, payback, operator strength?
All of the above. The one thing that's interesting about the gold space, though, is that we aren't seeing a lot of copper projects. We're not seeing a lot of lead zinc projects in terms of doing, byproduct, non-core byproduct, precious metal streams from base metal projects. We're not seeing investments into the base metal space. What we are seeing, though, is a lot of gold streams on gold mines. And it really does come down to, all of the above in terms of quality of the project, the operating margins of the project, the jurisdiction, the partners in terms of that. They're all factors that play into what kind of a return we need off of this. But, the biggest issue, the most unique aspect of the gold space right now is that if you look at the gold cost curve and then you look at the spot price, spot price of gold, I don't think I've ever seen such a gap, such a margin. And if you're in the gold mining business and you're not making money in today's world, something is wrong. Everyone should be profitable here. It's the cost curve. I've never seen such big disparity between a cost curve, and even the fourth quartile producers are looking pretty attractive in today's world.
Reddy, you and I have talked about U.S. debt before, quite a bit on the macro front. Bank of America just said gold could hit 4,000, not because of the war, but because of this unsustainable U.S. debt. And of course, the loss of this monetary trust we've been talking about. Trump's new tax spend package adds nearly $4 trillion to deficits. How does this thesis shape Wheaton's long-range pricing models and your confidence in underwriting new deals at today's metal prices?
Well, I don't mean to be flippant, but I mean, wars come and go. The real reason that I'm so bullish on gold long term is the U.S. dollar and the weakness behind it. And when I sit and look at the challenges that we have in countries like the United States, and they're not alone in this, in terms of trying to even just get close to balancing the books, it's beyond that. I was a bit astounded that it took this long for Mr. Musk to realize how governments have been operating for the last 20, 30 years. And it's one of the reasons he's been so negative on this budget bill going forward. Guess what? That's what we're dealing with. That's the framework that we're dealing with. And I just think that to me is the principal reason why I am so bullish on gold, is that it's pretty tough to be bullish on the US dollar. I can't find anything that has got long-term sustainable strength. You might get some short-term positives, success, stability, whatever, but the fundamentals behind it there's just nothing that gives you long-term confidence in terms of the US dollar, and that bodes well for gold.
Let's talk a little bit about policy. I mean, you're seeing what's happened in Mali. You're seeing that jurisdictional risk kind of come back into the market. How much of that is at the center of your mind when you're talking about some of these new deals?
Well, it's one of the reasons that we do focus on high margin projects is that those are the projects that can afford changes. And trust me, every government in the world is trying to find a way to generate more revenue, to pull more revenue in, to try and capture more of that capital flow. And so Mali, Panama, all sorts of jurisdictions. I hate to say it, you see it here in Canada, you see it here in all sorts of jurisdictions. And so trying to feed back that, making sure that you have healthy operating margins is one of the key aspects to make sure you go through that. It'd be nice if it came with some higher confidence in terms of moving these projects forward. And we definitely do hear the rhetoric in terms of improving permitting and trying to accelerate how you can bring these projects into a cash flow position in the first place. I'd love to see some substance behind that. Hopefully it's coming.
Actions speak louder than words. And you've been outspoken about Canada losing ground in the global resource race. With Ottawa now transitioning to a more pro-development cabinet, what specifically do you want to see change? Permitting, tax, regulatory execution?
Yes.
All of the above. Anything, really, at this point.
The thing that makes me most nervous about it is I'm not really a big fan on the investment from the government side. I think that if you can find a way to get through the permitting and the regulatory execution and actually deliver, that should be enough to take projects forward and let the markets drive the economics of driving these things. I'm not a big fan of our governments investing into projects to try and move them forward. Just accelerate and try and streamline the whole permitting process, and just give us a framework that we can work with and schedule around and deliver to our investors, on a timely basis. That would be enough from any government is to let the market itself finance these projects on a go-forward basis, and perhaps the support of the infrastructure side for more remote projects. But and especially if there's a broader benefit to those infrastructure investments, but just push it down the permitting and the regulatory side and try and accelerate that. Because when I see projects that have been waiting for permits for 4, 5, 6 years, that all costs investors substantially while you're keeping these projects going. You don't have any cash flow coming back, and so get out of the way.
So is it just bureaucracy at this point? Is private capital more comfortable investing in the mining space? Over 260 mining projects have been delayed across North America. Canada lost 4 potential Tier 1 discoveries since 2020. What kind of reform would move the needle? Is it not just on margins, but at scale?
Oh no, it's a different approach. It's an approach to sort of recognize that. And we are seeing this on a global basis, is that a stronger focus in terms of trying to ensure that we deliver what we consume within a country versus having to rely on our neighbors and rely on our trading partners. And so let's move down this path. Let's bring this forward. And that's been one of the challenges that we've seen, is that a lot of rhetoric on this space. Just get the permits in place. We've got projects in our portfolio. Most streams will supply a little bit of capital ahead of permits, but most streams, the capital gets drip fed during the construction process. We've got streams that are 15 years old in our portfolio waiting for permits to go forward, waiting for that investment decision. 15 years of patiently waiting to get that support. And society's got to recognize that, sometimes, in fact, most times, responsibly produced products in a much more controlled environment, i.e. here in Canada, where you've got stronger environmental regulations, stronger social license commitments and capabilities, there's a premium to that versus chasing off to some of the more obscure locations around the world where you don't get that same level and you don't have that cost. And so let's focus on trying to be the best that we can at what we're delivering. And such an opportunity here in Canada.
The future of streaming seems quite bright too. I'm curious, how do you kind of ask? Is streaming now functioning as a parallel financing system, essentially offering structured capital in place of the broken public markets?
No doubt. we've seen a real disconnect over the last, I'd say, last decade from the public market side.
Yeah.
And then, the other side that I would say has been a challenge is the shift away from active fund management towards passive following index mixes. And, I think in the mining space, in the resource space, active is very important, because the difference between, it's not easy to tell the difference between a good investment and a bad one in this industry. Yeah. And so not having that active management has had a negative impact on the public side. So streaming is definitely competitive. It's a source of equity investment in terms of the space, and currently much more attractive than the public markets. And I would say even more attractive than a lot of the debt. It's a cyclical market. I'm not foolish enough to think that we're always going to be the top of this space, but as long as we make good investments now that we can ride through and deliver, like we have, an incredible growth curve over the next 5, 6, 7 years with our existing portfolio, we can be patient and push this forward. And so it's definitely worked very well for us and our shareholders.
Yeah, you mentioned it's a cyclical market. I mean, Wheaton is now streaming projects in copper, lithium, rare metals. Could this model scale beyond mining into energy, infrastructure, even agriculture as credit markets tighten?
Jeremy, I just want to clarify. We only stream precious metals.
Exactly.
But the bulk of our precious metals come from copper mines. Mm-hmm. And so our whole focus is providing support by purchasing the non-core precious metal byproducts from these critical mineral mines. We don't touch lithium. That's not a space that we're interested in. We do have a little bit of cobalt from the Voisey's Bay mine, the cleanest, greenest cobalt in the world. But other than that, 99% of our revenue does come. It's all precious metals focused. But we are an excellent way to help finance the base metal, especially with the arbitrage in value, the precious metals buried within a base metal asset or a critical mineral asset. Taking that and bringing it into our company, as long as we share that arbitrage with the operator, it's a real win-win situation, which is our entire focus, is win-win.
Right. Yeah. And a heck of a time at these prices, too, on the gold and silver front. Okay, before we let you go, because you're a busy man, just a quick little rapid fire. What's the most underpriced trend in the metals right now?
I do think silver's got some good legs behind it. Things are starting to shine on the Western front, so to speak, in terms of precious metals investing, and silver always does well in that environment.
And where does Wheaton kind of want to grow next? By metal or jurisdiction?
Yes. Both.
Both.
To us, it's the quality of project. Whether it's silver or gold, we're agnostic. I slightly like silver better, but there's just not a lot of opportunities in the silver space. Yeah. Most silver comes from base metal projects. What I would like to see is some base metal investing, but the price of copper, the price of lead zinc has not been strong enough to justify those capital investments yet. Mm-hmm. Let's see some strength in the space.
So then that's good. If we see that, finish this sentence. By 2026, silver will be...
Well, you've already got 40 out of me.
So. I already got 40. I'll deal with 40. Randy Smallwood, of course, the CEO of Wheaton Precious Metal. I noticed, too, you got some new management. Obviously, you're planning for the future over there, too?
Yeah, it's not new management by any means.
Not new management, some new positions. Yeah.
Some new positions, some promotions from within. Look, there's no doubt we've had an incredible run. Hatham, Kurt, the whole management team, everyone at this company has done a fantastic job. And so I think it's good to recognize that and reward that and sort of lay out the path forward. And so, congrats and well earned by both of them.
Yeah, and to you too. I know that you're just printing these margins. Going into Q3 is going to be a heck of a time. Randy Smallwood, CEO of Wheaton Precious Metals. Thanks for this, Randy. See you soon. Wishing you a wonderful summer.
Sounds good, Jeremy. Thank you. Same to you.
Appreciate it. Thanks for your time. And of course, for more expert interviews and hard-hitting market coverage, head to Kitco.com and subscribe to our YouTube channel. For Kitco News, I'm Jeremy Szafron. Thanks for watching.